everyone. Today is Friday, July 29th, 2022. My name is Evan, and I want to welcome you back to another edition of Stock Market Weekly, episode 642, presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves across financial markets. If it's your first time tuning into this video, welcome. Thanks for being here. Thanks for spending your time with us. Here's how these videos work. We break up our analysis into two parts. In part one, we look through the numbers, pick apart everything that stands out, looks different, interesting, or notable. And then in part two, we jump into the charts. We take a very close look at price action. We map some of those key support, resistance, trend lines, areas that we want to be paying attention to manage risk and find opportunity. And so without any further, let's jump into some of the key takeaways, some of the headlines and notes we're going to be talking about in this episode. First and foremost, it was an extremely busy week out there between all of the key large earnings tech companies that were reporting this week. We had the Fed out with their latest decision on Fed funds rates, and we had GDP prints, just tons of stuff hitting the tape. The market absorbed it all and proceeded to rally, rally, and rally. We saw constructive price action starting on Wednesday. So that was the Fed day. We started this week lower. We rebounded aggressively. This followed our blueprint of price action in the bull case from last week's episode to a T. We're going to talk a lot more about this in part two. We had the Nasdaq 100 print a bullish engulfing monthly bar. We have the 10-year Treasury yield finally back below its recent multi-month lows, so it's trading around 2.7, below 2.7. We saw a massive rally in silver. We're going to look at some earnings reactions, and we're going to talk about some of the catalysts looking ahead. So all that in this episode. Let's start looking through some of this data here. If we look at the right-hand column, you can see it was a monster week here, unanimous across the board, very even race, in fact. S&P, Nasdaq, Russell, all up, almost identical here, 4.5%. And take a quick look now at the 1 month numbers on the US markets. All double digits here, except for the S&P 500, but it's pretty close. Almost 10% across the last 1 month. So we've very sharply started to move higher here, and there's been clues along the way. We talked a lot about them in last week's video, but we're starting to just see more incremental data that is supporting the bull case. Now, not to say that there's not risk. We're going to talk about that. The market has moved in a very, sharp move across a short amount of time. This was a tweet I saw from Lisa. I'm going to butcher her last name, but that's her Twitter handle. So it's not my data. But basically here, she's referencing the fact that this move over the past 2 days here, or the 2 days following the Fed, was the largest rally in market history going back to the 1970s here. You can see the reaction to a Fed meeting here, and this was one of the strongest we've seen. The second strongest, in fact, was earlier in this year. So the market really seeing some impressive moves following these meetings. There's lots of reasons why I think we could draw some conclusions as to why that's happening. I think just lots of folks wanted to be risk off this week. They wanted to either put on hedges, raise cash. They knew the Fed was going to be out with their comments, but then we also had so many earnings this week that I think a lot of the traders that I spoke to just said, I'd rather not even deal with this and just reassess afterwards. And that I have to believe that this caused a lot of that knee-jerk reaction higher. You've got traders now that are forced to either chase this market higher or continue to sit on the sidelines. But I thought that was an interesting stat. If we take a look at our market trends, remember last week we talked about the fact that we started to get the 50 SMA, which seems wild, to actually begin rising here. And we see that expanding now to the S&P 500. So we've got now S&P, Nasdaq, Russell with a rising 50-period simple moving average along with that 10 SMA. So things, again, from a trend perspective and a price action perspective, have been improving out there. Still no change on the big long-term 200 SMA at this time. Now, volatility environment, again, this has been something that has been positive here. This was almost the preemptive lead here into what is now the bullish resolve higher, but the VIX here has been, again, just being very heavy to the downside. We saw the VIX again drop lower this week. It's now trading at 21.31, and we have the Nasdaq Volatility Index, which was down over 2 points, trading 26.96. So again, you're seeing that fear coming out of the market, and you're seeing the lowest levels in volatility in the recent weeks and months, almost towards this year. Now, I wanted to throw this in here, not because we're making new lows, but I just want to show the relative change here from the peak drawdown that we saw about a month ago to where we are now. And so you can see the S&P 500, and these are intraday numbers I'm looking at, had about a 24% drawdown, 24.5%. From peak to peak, peak to trough. And so you can see now we're about 14%. Nasdaq 100 still correcting 22%, Russell 22%. So you can still see that we're down pretty sharply from the cycle highs made many months ago, but they are increasingly getting further and further away from the trough that we saw a month ago as well. So just some perspective there for everyone to take a look at. Now, this is where, again, there's still plenty of room for improvement, which is the number of stocks hitting 52-week highs versus lows. We've been tracking this every week. We talk about this, and the last week or two, we've been basically saying here how the number of stocks hitting new lows have been drying up, but we need to see more stocks actually making new highs. And you can see, again, this is a pretty even ratio this week. We saw essentially just an arms race here between the number of stocks hitting highs and lows. And part of this has to do with some of the cycle rotation that we've seen, the sector rotation rather, that we've seen in the market. We saw, basically energy stocks start trading places with some of the cyclicals and tech names. And so you've got lots of names that are basically not at highs, not at lows, and we're still in this kind of in-between phase. But broadly speaking here, again, we want to see this top row start to increase. We're going to continue to measure this every single week. That will give more confidence and bullishness to the bull case. Now, I also wanted to throw this in here. So this is, again, a tweet I captured here from Charlie Bolello, who reported these numbers of essentially the big FANG components here, and just, the massive companies that the market looks to for guidance and just overall state of the economy. And what he's illustrating here is that, even though we are getting this positive market reaction in the short term, we still have basically the slowest either in the company's history or slowest in a certain amount of time, going back, 10 years or multiple years of revenue growth. So for instance, Apple, I think is, again, the one that was talked about a lot about. Basically, we saw this nice rally in Apple following their earnings announcement. I think they were up, 3% on the day, and their revenue growth was 2% year over year. So these numbers are coming down, and maybe this tells us that we're not out of the woods yet in terms of this big macro tough spot that we're in, but at least in the short term, the market doesn't seem to care about these lower numbers. So again, interesting coming out from Charlie on Twitter. Now, sector performance here, everything was green. Everything was a winner this week. Energy was the top of the list, up 10%, coming back real strong. Remember, energy had gotten hammered there for the past 3-4 weeks or so, but we're seeing a sharp rebound there. Utilities really coming back strong as well. This is a big move for the XLU, and industrials in the third spot, almost 6%. On the downside, communication services, consumer staples, and healthcare were up 1 to 2%. Now, 10-day correlations, threw these in here as well. Again, nothing too different here from what we've been tracking. Basically, you're still getting a lot of tight correlation between all of equity markets. You're seeing a very, very tight inverse correlation to what the dollar is doing and what equities are doing. And so we continue to see the US dollar pull back right now, and that is letting up or taking off the pressure here for all risk assets. Commodities are starting to do better here. You got things like Bitcoin, you got risk asset appetite here in equity markets. Everything likes the fact that the dollar is coming down. So we're going to continue to watch that. We'll talk about that price action in part 2. And if we look at Treasury yields, this is also the big story. One of the top takeaways from this week is we've got yields that are continuing to fall here. Take a look at the 10-year Treasury yield, 2.64% this week. Last week, we're up around 2.78. This is another theme that we've been talking about here, basically, to oversimplify things, Treasury yields stabilizing, sideways or pulling back would be a good thing, particularly for long duration assets, technology, so on and so forth. And that continues to be the case. You've got Treasury yields coming down. You've got the dollar that is pulling back. That is what, frankly, is helping U.S. Equity markets be able to sustain a rally or put in the rally that we saw. Last but not least here is dollar and commodities. Speaking of all of that, we saw silver at the top of the list. We're going to talk about this price action here. 9% to the upside. Silver really had been getting pretty hammered here over the past few weeks, so a very aggressive rebound there. Bitcoin continues to rally up, trading comfortably now over 20K. Crude oil, agriculture, gold, natural gas, again, everything working this week. Dollar index in the red there, so thank you to the dollar for everyone else that has been able to profit at that expense. So that is it for our free version of the Stock Market Weekly video. We are going to continue on here in just a second with part 2. We're going to talk a lot more about price action. We're going to measure and map some key levels, look at some different indicators that are starting to transition. So if you would like to get the full version for this episode, you can buy it for $5, or you can subscribe for a monthly membership for $15. Save yourself some cash. Get 4 episodes for the price of 3. Head to thetraderist.com/SMW. Or if you want to learn more about what's included in this series, you can follow this link down here. So thank you for watching as always. And for those of you continuing on, we'll get started here in just a second.